Welcome everyone. So we're going to be looking at Teladoc stock today. We'll be taking a look at the financials of the company, the growth, the debt, and also a DCF model to try to get a fair idea of their intrinsic value. Now before we jump into the meat of this, if you enjoy this kind of content where I do valuations on companies and run these models, go ahead and sub to the channel. Also, don't forget to give the video a thumbs up. It really does help the channel out. So let's go ahead and jump right into the growth of the company. So you can see that Teladoc's been nothing short of incredible growth, and part of that had to do with the obvious boost that they got from the pandemic. You're talking in 2017, they had $233 million in revenue. To now in 2021, it's grown to a little over $2 billion in revenue. That is incredible growth. But you can see, even though the growth was pretty good, from 2017 to 2019, it was good. But then you saw a substantial jump from 2019 to 2020 and 2020 to 2021. It certainly cannot be denied that Teladoc's business model has been boosted by the pandemic. Now, this is a growing company still, and you're not going to see much consistency when it comes to their net income or free cash flow. Net income is practically the lowest it has ever been at negative $429 million in 2021. Free cash flow for 2021 is the best it's ever been, though. But if you look at these numbers, you definitely see a lot of inconsistency. Next, we'll go ahead and take a look at Teladoc's debt. Now, this isn't really going to be fair because it's a growing company and, in a way, still young yet. So when you look at the average of their last 5 years of free cash flow, it's only going to be a measly $17 million. Of course, when we look at a business, but typically more stable ones, we like to multiply that average by 3. In this case, this is only going to give us $51 million. We like to see that the long-term liabilities are lower than this number. It's $1.2 billion. Obviously, it's not. However, on the positive side of this, their current assets do outweigh their current liabilities. So, if the company were to liquidate today, their current assets are worth more than their current liabilities. Okay, now moving on to the DCF model so we can try to get somewhat of a fair value for the company. Teladoc has seen some really great revenue growth, and if you look at the average analyst over the next 2 years on average, they seem to think it'll be about 25% growth on average. I like to obviously stay conservative and go lower than the analyst, but in this case, I just went ahead and went with 25% over the next 5 years. The main reason for this is I do not expect this to be some great deal. So for anyone who's watching and is probably an investor in Teladoc, I just kind of want to give perspective on where this company is really at. So that's why I go ahead and stick with the analyst on their growth estimates. So as we jump into the model, we grow that revenue out by 25% over the next 5 years. And that'll grow out to $6.2 billion in the year 2026. We had to come up with a free cash flow margin to apply to these projected revenues. Now, normally what you would do is look at the last 5 years of free cash flow in comparison to the last 5 years of revenue and come up with margins based on that. However, in their case, they really only had one meaningful free cash flow year where it was positive, and that was 2021. So I went ahead and divided that by the revenue for 2021. We get a free cash flow margin of about 6.4%. We apply that to all the projected revenues. We need to come up with a terminal value. We applied a weighted average cost of capital of 5.5%. You can find this figure on finbox.com. I also applied a perpetual growth rate of 2.5%. Now we need to discount all those numbers. I use a rate of return of 12%. We add all the values up. divide by shares outstanding, and we're getting an intrinsic value of about 53.73, or we'll just round it up and call it a fair value of $54 a share. So the fair value is coming out close to current share price. However, I definitely would not be a buyer at this point. It's something where I'm really starting to pay attention to the stock, and I want to go ahead now and explain why. First of all, I base this off of 2021's free cash flow. This model was all under the assumption that free cash flow is going to stay positive because the business model is starting to stabilize. If you look at just the year before, in 2020, the free cash flow was negative 79 million. So yeah, free cash flow has been very inconsistent. So part of this model is assuming that the business is finally starting to stabilize and you're not going to dip into negative free cash flow again. So one thing we want to look out for is I'm starting to pay attention to the stock. We want to see that free cash flow stays positive. Now that's not something we have to wait years for. We can just start paying attention to that over the next couple quarters for their earnings. You'll get a really good idea quick if that free cash flow is really going to start to stay positive. So if the first quarter for 2022 ends up being something like 50 million, you could then venture a guess, hey, maybe the overall for 2022 will be like 200 million or more, which would be really good compared to the 130 million in 2021. It would definitely give me an idea as an investor that finally the business is starting to stabilize a bit more, and we're not only going to stay in positive free cash flow, but perhaps consistently increase. So again, two things to look out for with that. One, we want to make sure the free cash flow is staying positive, because that means that the business model is starting to stabilize a bit better. But two, if the free cash flow starts to get much, much better in the coming years, we can actually apply a much better free cash flow margin when doing this model. Okay, now next thing we need to definitely look at is the shares outstanding. In my model, I did not account for any share dilution, and let's be honest, there's been share dilution every single year for this company. If we just take a look at the last 5 years, you'll see in 2017, the shares outstanding was 55 million. Now in 2021, it's 160 million. Overall, you're seeing consistent shares outstanding increase here, but really not that much. It wasn't that dramatic. That is until we hit the year 2021. 2020's shares outstanding was 91 million. 2021 jumped up to 160 million. That is an insane jump. Remember, companies dilute their shareholders as they are trying to grow. Reason being is they don't want to take on debt. When you're trying to grow as a company and you don't have the money or the free cash flow to support that growth yet, there's only two ways that you can support that growth. One is you take on debt. And a lot of companies don't want to take on an insane amount of debt. Or two, you dilute your shareholders to pay for that growth. I do believe in 2021, the shares outstanding jumped up so dramatically because of that Livongo deal. They really had to do a lot of share dilution to pay for that deal. So again, I'm not a buyer at these levels, but based on this model, we're pretty much close to fair value, and this is something I can start to pay attention to. To recap, we want to pay attention over the next coming quarters of earnings to see, hey, is the free cash flow starting to stabilize and stay positive and even grow? And is it growing enough where we can use a better free cash flow margin? If that's the case, that's good for the model. But two, we want to look out for share dilution. We want to see how much Teladoc intends to dilute its shareholders over the coming quarters in the coming year. History tells us that they're probably going to dilute the shareholders to some amount, but as long as it goes back to the way it was and not the ridiculous year that 2021 was, then we really shouldn't be looking too bad. Again, this is starting to intrigue me. I didn't even think it was going to be close on the model, but still, this is a company I'm just going to watch, and I want to see what happens over the next quarter or two. Okay, let me know what you think about about Teladoc down below. Are you an investor right now in them? Is it still a little too risky and you're waiting to see what happens? Let me know down below, and we're going to wrap this one up. So everyone have a great day.